Hello everyone, welcome back to Options Made Simple. Today we're going to go over debit spreads, which are also known as vertical spreads. A vertical spread involves the buying and selling of options, which usually gives a trader the advantage of lowering the cost basis for their options that they purchased. There are many ways that spreads can be implemented to your advantage, so in this video we're going to go over the advantages or disadvantages of spreads and give a few examples of scenarios you would want to use them in. Anytime you buy a spread, meaning you paid for it rather than received a credit, that is a debit spread. Call debit spreads are bullish and put debit spreads are bearish. To open a debit spread, whether it's a call or put spread, you would first start by choosing a strike price for the option you want to purchase, and then sell an option that is further out the money than the option you buy. For example, with a call debit spread, you could buy one call with a $35 strike and then sell a call with a $40 strike. Or for a put debit spread, you could buy the $20 strike and sell the $10 strike. But before we go further, let's break down what we're actually doing by buying and selling options with the same expiration date. Remember, buying a call is an agreement to buy 100 shares, while selling a call is an agreement to sell 100 shares. So by buying the $35 strike and then selling the $40 strike, we're essentially agreeing to buy 100 shares at $35 and then sell them for $40 a share. Now for the puts. Remember, buying a put is an agreement to sell 100 shares at the strike price, while selling a put is an agreement to buy 100 shares at the strike price. So buying the $20 strike and selling the $10 strike would be the same as buying shares at $10 and selling them for $20. Alright, so now that we've discussed what we're actually doing, we'll use Lululemon for the call debit spread example. Lulu is currently trading at $329 a share. Let's say you're bullish on Lulu and believe that it was going to surpass $340 within a month. Right now, the 30-day call contracts for the 340 strike are trading for $7.60. So if you just bought the 340 call naked, you would need Lulu to actually be above $347 by expiration in order for you to pull a profit on that trade. If you were more conservative and bought the 30-day at the money 330 call, you would pay $11.95 for that option. Your break-even price is now lower at $341.95, but you have more money at risk for this trade and still need to surpass $341 for significant profit. Rather than buying naked calls, you can set up a call debit spread by buying the at-the-money $330 option and selling the out-the-money $340 option. So you would buy the 330 call for $1,195 and you would sell the 340 call for $760. This spread would cost you a debit of $4.35. That means your break-even price for the trade is now $334.35, which makes the likelihood of this trade being profitable for you much higher. The most you stand to lose on this trade is the $435 that you paid for the spread. In order to find the maximum profit for your trade, you would subtract your strike prices and then subtract the debit you paid for the spread. The maximum profit for the spread would be $565. In order for your spread to reach maximum profit, the share price of Lulu would have to be at or above $340 when the spread expires. If this happens, both of your options execute and you would buy 100 shares for $330 and sell them for $340, and the only cost to you was what you paid for the spread. But this doesn't always happen. Let's talk about what happens if your spread were to close in between your two option legs. If Lulu only made it to $338 rather than $340, this trade would still be profitable for you because you surpassed your break-even point of $334.35. Since only your long leg is in the money and your short leg is out the money, this means that only your long leg, the $330 strike, will be exercised. You would have to buy 100 shares at $330 a share and then sell them at the market price of $338 a share. That would net you $800 minus the $435 you paid for the spread. Your total profit would be $365. Mind you, you would have to have $33,000 in your account to buy the shares if your contract was exercised. Otherwise, you'll want to sell your spread the day of expiration to avoid getting in trouble with your broker. As with all options, the greater risk you take, the greater your potential reward is. If you really thought that Lulu was going to take off within the next month, you could buy a spread that was further out the money to decrease the debit you would pay and increase your maximum profit. For example, you could buy the 350 strike for $4.65 and sell the 360 strike for $2.35. This spread would cost you $2.30. Your break even would be $352.30. Your max loss would be $230, and you would have a maximum gain of $770. Now let's talk about the best scenarios to do debit spreads in. Debit spreads are most effective when the out-the-money options you sell have higher IV than at-the-money options. Cheap and expensive is an important concept here. You always want to be buying cheap options and selling expensive options. The more premium you receive from the out-the-money option, the lower your break-even price is and the higher your profit potential will be. AMC is currently a good example for this. AMC is trading at about $45 a share right now. The $45 put option has an IV of 211%, while the $25 put option has an IV of 268%. This tells me that the out-the-money put options are trading expensive relative to the at-the-money options, and the pricing of the options would support this. The $45 strike costs $20.15, while the $25 strike is trading for $16.20. This means by selling the $25 strike, you pay off over 80% of the $45 put option, giving me a break-even point of $41.05. The maximum risk is $3.95, while your maximum profit potential is almost 4 times that of $1,605. One thing to be aware of is that this spread would be very sensitive to increases in implied volatility. If AMC did make a huge move to the downside, a large increase in the implied volatility would inflate the value of that $25 option. This means that although the trade would be profitable for you, the large increase in the extrinsic value of the $25 option will be somewhat of a barrier to you achieving a majority of the profit early. The $25 option would have to experience an IV crush in order for the spread to become more profitable. Otherwise, to achieve max profit, you would have to hold the spread until expiration and hope that the price stayed below $25 a share. The last thing I'll add about debit spreads is that you can uncap them at any time. Sometimes if you open up a spread and the share price moves against the direction of your spread, although your spread will lose value, the short legs of that spread will actually gain value. So if you're still confident that the underlying is going to move in the direction that you have predicted, you could sell the short leg at a profit, which would still be paying off some of the cost of your long leg. By selling off the short leg, you would be uncapping your trade, giving you greater profit potential, although it would increase your maximum potential loss. In addition, if you have a naked option that you have bought that has increased in value, to give yourself downside protection, you can actually turn that option into a spread. If you're able to sell an at-the-money option at a price that is equal to or greater than the cost you paid for your original option, you now have opened up a risk-free trade that cannot go negative. Of course, you did add a cap to your profit potential, but I usually sleep better at night when I know I have some downside protection. So now that you know all there is to know about debit spreads, have fun trying them out and feel free to leave any questions in the comments. See you guys next time.